document that we are seeing here. But anyway, that's one thought I thought of telling you. Why I brought this here? We studied IAS 1, we studied IAS 2. IAS 1 we talked about presentation of financial statement. How a financial statement should be produced. Financial statement will have a title page. Side up. Is it because here? Yeah. See, you will have the title page. First page is they will give the name of the company. One of the requirement of IAS 1. You need to say for which company that we are producing the financial statement. Second, we need to name the document. Document name is financial statements and independent auditor's report. Why we have to say both? Because auditor's report is not a document of the company and financial statement is not a document of the auditor. But we combine both and we produce a single document. That's why we had to name like this. And then we also need to state the period of which we are preparing the financial statement. So these will be produced or reflected in the very first page. Then we move on to auditor's report. I am not here to talk about it. And then it carries certain various aspects. Then we have the statement of financial position. That talks about our current financial state. How good we are, how strong we are in terms of our business, which we can understand by reading this. Now you see here, I have 1,742,000 under my equity, and that 1,742,000 is a plus number, meaning the owners of the company can enjoy and entertain that 1.7 million worth of reals for the year. If you really look into the last year, there is a reduction. Do you see that? Because of the various scenarios here, it's reduced. And then, mainly, the partners have taken more money during this year. So, this 1.7 is made up of you see here, I have 2.5 million worth of total assets, including non-current assets and current assets. And then I have total current non-current liability of 121 and current liability of 654. If you take the total of these two and subtract from this 2.5, you will arrive 1.7. This is the breakdown of how we arrived the equity. Anyway, today we wanted to discuss cash flow statement. Now, looking at the statement of financial position, in short, to keep us our word of mouth simple, we use the term balance sheet. If you look into the balance sheet, I have the cash and cash equivalent here, and last year I have 29,000. And what has happened to the current year? It became 6,745. So, what has really happened? Has it been increased or decreased? The current year compared to last year, reduced or decreased. So, the cash has reduced. If you only produce this and give it to the shareholder, he reads this and then he will get a shock, bloody hell, beginning of the year. Now if I produce another question to you, on 1st of January, let's say, I believe it is 2022, yeah, 2022 and 2021. So 1st of January 2022, how much is my cash? 29,000. On 31st December, how much the cash is? 6,745. So what has happened actually? Reduction. So the shareholder get a heart attack possibly. Although the numbers are like this, if the numbers are very big, then definitely we need to have aspirin tablet with us to control his shock in his heart. Now, only give this to him and then you have to sit on the annual general meeting and these people will come up with a lot of questions. What has bloody reason for the reduction of this cash? So you got to explain this. Accordingly, IASB needs us to go and produce another statement named cash flow statement. Look into the history of the way the cash flow statements have been produced. There was a different requirement in the past time known as fund flow statement. It was the old previous need. There we don't reconcile the cash. Here what we do really, we reconcile the cash. We reconcile this movement. We reconcile that movement. So we instead of reconciling the cash, we reconcile the working capital. Can someone define me what is working capital? Either you can define me through an equation.
Current assets minus
Current assets minus
current liability.
Very good. Working capital is equal to current assets minus current liability. Current assets comprise of what are the components? Yeah, tell me.
Cash,
Cash,
inventory, bank balance.
Cash and bank I will put together. Inventory, receivable mainly. Then you may also have prepayments. I am not here to talk about it. So these three items will comprise your current assets. Current liability, mainly payable and accrued expenses. So the four items: inventory, receivable, cash and payable. So what previous standard requirement was to reconcile every single movement between inventory to inventory, receivable to receivable, payable to payable, and accordingly cash to cash. But that has become invalidated, outdated, and then they came up with requesting you to produce cash movement between the periods. Standard says that a detailed analysis you should provide to the shareholders, or I wouldn't use the term shareholder, I would use the term user. You would produce a detailed reconciliation to the users of the financial statement to understand what has really happened to your cash movements. Example, during the year, customers could be paying a huge lot of money. You would keep collecting it. You know, especially working in Middle East, I used to face a problem. You saw, now if I go to see how much is my profit? 962,000. And when I go to cash, 6,700. Fair other five. Fair five Marana. Fair Marana plus. Where is my cash? I had it enough. Many owners, when I am sitting over the table, keeping the financial on the table and talking to them, they don't simply understand the bloody cash flow statement or the relationship between the profits and the cash flow, cash. There is a statement saying profit is a concept. Profit is simply a concept, whereas cash is king. Now, in arriving profits, you have lot of different concepts. You have accrual concepts. You incorporate credit sales. When you incorporate credit sales, you have receivables. You didn't receive the cash. And you also do depreciation. You show that as expense in your income statement, but from your pocket, no cash is going. Likewise, there is different. Now, company A will follow straight line method depreciation. Company B may follow reducing balance based depreciation. So again, the differences might come accordingly. So you have to have a very good understanding between this number and the number what you see here. So this document, what we're going to produce is cash flow statement. Now coming to IAS 7, for any standard, I told you last class also, you have first objective. What do you think the objective of IAS 7? In order to elaborate a detailed knowledge of how to prepare a cash flow statement which will make the user a good understanding. That should be the objective. Maybe the phrase that the standard using could be very high standard English compared to what I told you now. But I have made it very simple. So this is the objective, number one. Number two, scope. Scope would be to prepare a cash flow statement for general purpose financial statement. A general purpose financial statement. And for that to cover all the requirements of cash flow statement for general purpose financial statement. That is the scope. Third is definitions. In this IAS 7, there are key words that we need to define. First is cash. How would you define cash? What is cash? Money at hand. Very good. Masbul. Any other? Is that only money at hand is cash? Cash in hand and cash at bank. Whatever cash that is immediately you can use it without unnecessary additional efforts. That is cash. Secondly, we also have something called cash equivalents. What do you think the cash equivalent? It is not cash, but it takes the form of the cash. The standard uses the term when converting any form of financial assets to cash with insignificant risk of, follow the word, insignificant risk of losing the value. Let's say you have deposits in the bank. You walk into the bank, you tell the customer, front office staff, I need 100,000 now. And you deposit also 100,000 in the bank. He converts and transfers to your current account. You don't lose it. As in even a less than 1%. Oh, you simply don't use it anything. Number two, you also don't wait for 2 months, 3 months, 1 week to get the money. Now, people who would have had fixed deposits and then when they want to uplift, I hope you all know the meaning of the term uplift. The meaning of the term uplift is who had or have fixed deposit? May I know? I don't ask the amount. In your own country or here, $100 million. Oh, okay.
They're scared.
Okay.
People are scared.
They think that I will ask loan. No, don't worry, I will not ask loan. I am not going to ask you phone numbers. Don't. Now, let's assume Mr. A is very happy man, Mr. A, and he has 100 million only for the theory sake dollars in a bank as a fixed deposit. He deposited this for 2-3 years before, and he is enjoying the profits or the interest, however you phrase it, on a monthly basis. It is happening separately. Now, on 1 January 2024, he wanted to invest into a project. He needs $50 million. He goes to bank. He says that, my friend, I need 50 million of this. This requesting 50 million from the fixed deposit, that process is what you call uplifting. So when you needed to uplift a deposit from a bank, normal procedures they will say that if you go and ask today, currently the bank giving today, no time left, but in the past they will say that you got to wait for 1 day, 1 week, 2 weeks like this. There's so much of documentation, so much of procedures, need to send the document to head office and they need to sign and the courier has to come, so much of story. Fadal.
Yes.
So, if you had to wait a significant time or a time is lapsing, and then again that will not be called as cash equivalence. The cash equivalence is in a different form other than cash, but it plays the role of the cash. Clear? So that's the second term. Then the third term would be today I cancel my schedule for gym because I know that I have lecture here. So third term. Now we also talk about activities in a business according to, now when I say in general, when I say activity, it could mean anything, but according to IAS 7, they go on to define or differentiate activities of a business into 3 headings. Amal, you got to split the videos. Stop and continue this. Okay. So activities are categorized into 3 headings. Can someone tell me what are those activities?
Operational activity.
Pardon?
Cash from operation.
Cash